Hey there! Right now, one single number sitting inside the US stock market is the second highest it has been in roughly 145 years, beaten only by the dot-com peak in 2000. And that number isn't even the scary part. The scary part is this. By one specific measure, today's AI-driven market is actually more concentrated in a handful of stocks than the market was at the peak of the dot-com bubble. Not slightly more, close to 1.5 times more. So when people say, don't worry, this isn't like 2000, the data says something a little more complicated than that. Let's actually look at the chart. In this video, we'll cover what this bubble chart actually measures and why it matters. The 2 times in history it flashed this red before, where it sits right now with AI stocks driving it, the strongest argument for why this time might genuinely be different, and a real case study from the dot-com era that shows why even the safest bet in a hot market can still get crushed. Disclaimer, before we dive in, this is not financial advice. This video is purely educational. Always do your own research before making any financial decisions. Section 1. The chart that keeps showing up before crashes. Let's start with the number itself. It's called the Shiller CAPE ratio. CAPE stands for cyclically adjusted price to earnings. That sounds complicated, so let's break it down with an analogy. Imagine your friend Bob is thinking about buying a small coffee shop. A normal person would ask, how much profit did this shop make last year? But smart investors like Bob know that one single year can be misleading. Maybe last year was an unusually great year or an unusually bad one. So instead, Bob looks at the shop's average profit over the last 10 years, adjusts it for inflation, and then compares that smoothed-out number to the asking price. That's basically what the Shiller CAPE ratio does, except for the entire US stock market, instead of one coffee shop. It takes average inflation-adjusted earnings over the past decade and compares that to today's price. Why 10 years instead of 1? Because it smooths out temporary booms and busts, giving a more honest read on whether stocks, as a whole, are expensive or cheap relative to their real, longer-term earning power. Here's why this particular number matters so much. Historically, whenever this ratio has climbed to extreme rare highs, it has been followed, not always immediately, but eventually, by a serious market correction. That's why people watch it. It's not a perfect crystal ball, and it has never been great at timing the exact moment a crash happens. But as a warning signal for stocks are historically expensive relative to real earnings, its track record is hard to ignore. Section 2. The 2 times this exact chart flashed red. So, let's find out when this number has actually spiked to extreme highs before, because it's only happened a handful of times in over a century of data. The first notable spike was right before the crash of 1929, when the CAPE ratio climbed into the high 20s to low 30s, elevated for its time but nowhere near what came next. The second, and still the highest reading ever recorded, was right at the peak of the dot-com bubble in early 2000, when the CAPE ratio hit roughly 44, the most expensive the US stock market has ever been by this measure. We all know what happened next. The Nasdaq, packed with internet companies trading on hype instead of profits, peaked at 5,048 points in March 2000, then fell all the way down to 1,139 points by October 2002. That's a roughly 78% collapse from peak to trough. It took the Nasdaq 15 years, until 2015, to finally climb back above that original 2000 high. Now, here's the part that should get your attention. As of mid-2026, that same Shiller CAPE ratio is sitting around 41 to 42, having crossed the 40 mark for only the second time in a century of data. That makes today's reading the second highest in roughly 145 years of recorded market history, clearly above the 1929 level and closing in on the all-time record set in 2000. In other words, this chart has only flashed this red a small handful of times ever. And every single one of those previous instances was eventually followed by a major correction. That doesn't mean history has to repeat itself exactly, but it's exactly why this chart keeps getting pulled up in finance videos, analyst reports, and yes, dinner table arguments about whether the AI boom is the real deal or the next .com. Section 3. Why some people say it's actually worse than 2000. So here's the part that makes today's situation genuinely worth paying attention to, beyond just the number is high again. During the dot-com bubble, the excitement was spread across hundreds of companies, plenty of them barely profitable, some of them not profitable at all, riding pure hype into sky-high valuations. Today's AI boom looks different on the surface. It's concentrated in a much smaller group of companies. Nvidia, Microsoft, Alphabet, Amazon, and Meta lead the pack. And those companies are undeniably profitable, with real cash flow funding their AI spending. But here's the twist. That concentration is actually part of the concern, not the reassurance. Today, the top 10 companies in the S&P 500 account for somewhere between 40% and 43% of the index's entire market value. A record. Back at the actual peak of the dot-com bubble in 2000, the top 10 accounted for roughly 27%. Do the math, and today's concentration is close to 1.5 times higher than it was at the most concentrated point of the dot-com era. Nvidia alone is a huge part of that story. From its lows around $337 billion in October 2022, Nvidia's market cap climbed to roughly $5.1 trillion by mid-2026, making it the single most valuable company on Earth, and something like a 15-fold increase in under 4 years. When that much of the market's total value depends on the continued growth story of a handful of companies, a stumble in any one of them doesn't stay contained. It can drag the entire index down with it. That's the "it's worse" argument in a nutshell. Fewer companies carrying more of the weight, all riding on the same AI growth story. Section 4, the strongest counter-argument. Why this time might be different now, to be fair, and this channel doesn't do one-sided hype in either direction. There's a genuinely strong case for why comparing today directly to 2000 misses something important. Unlike most dot-com-era companies, today's AI leaders generate enormous real revenue and operating cash flow. Nvidia's data center segment alone reported around $197 billion in revenue for fiscal year 2026. Cloud providers like AWS, Azure, and Google Cloud report that their AI computing capacity gets fully booked almost as fast as it's built, meaning the infrastructure spending is tied to actual immediate demand, not speculative hope that customers will show up eventually, which was the fatal flaw for a lot of dot-com companies. In other words, back in 2000, plenty of companies were valued on the promise of future profit that never came. Today's largest AI players are, for the most part, already deeply profitable, funding this AI build-out with cash they're actually generating, not just investor money and debt. And here's a number that actually supports the bulls. Even though today's top 10 companies hold roughly 43% of the S&P 500's market value, they also generate around 30% of the index's total earnings, meaning their dominance is backed by real profit, not just narrative. Compare that to 2000, when a safe, fundamentally sound bellwether stock like Cisco was still trading at roughly 130 times forward earnings. A price nowhere close to justified by the profits underneath it. That's why the honest answer to "is this a bubble or not" isn't a clean yes or no. It's the valuation numbers rhyme uncomfortably with the two most extreme bubbles in market history, but the underlying business fundamentals, profitability, cash flow, real customer demand, look meaningfully stronger than they did in 2000. Whether that fundamental strength is enough to justify today's prices, or whether the market has simply priced in years of future growth that hasn't happened yet, is the actual debate professional investors are having right now. Closing case study. Let's ground this in a real story from the dot-com era. And it has a genuinely surprising ending that connects directly back to today's AI boom. In March 2000, at the very peak of the dot-com bubble, Cisco Systems, the company literally building the physical hardware that ran the internet with real revenue, real profit, and real customers, briefly became the most valuable company in the entire world, worth more than $500 billion. Cisco wasn't some random speculative startup. It was considered one of the safe, fundamentally sound bets of the entire boom, because unlike Pets.com or Webvan, Cisco actually made money. And yet, when the bubble popped, Cisco's stock collapsed by roughly 88%, from about $79 down to under $10 within 2 years. That's how brutally a correction can treat even a profitable category-leading company once an entire sector gets this overheated. Here's the twist. Cisco's stock didn't just eventually recover. It took 25 years, 8 months, and 13 days. In December 2025, Cisco finally closed above its March 2000 high for the first time ever. And the reason it finally got there isn't nostalgia. It's the current AI infrastructure boom. Hyperscale cloud companies placed over $1 billion in AI networking orders with Cisco in a single quarter, driving the stock to a genuine new record. Analysts have also pointed out that Cisco's valuation today, even at this new high, is nowhere near the extreme multiple it traded at in 2000, meaning this comeback rally, unlike the original 2000 peak, is actually backed by realistic pricing relative to profit. Conclusion. So, is the AI bubble worse than the dot-com bubble? Based on the data, specifically how concentrated today's gains are in a small handful of companies, and how historically stretched valuations are by the Shiller CAPE measure, there's a real defensible case that the setup looks even more extreme this time. But based on the underlying business fundamentals, real profits, real cash flow, real customer demand, there's an equally real case that today's leaders are standing on much firmer ground than the dot-com companies of 2000 ever were. The honest, unsatisfying truth is that nobody, not this channel, not Wall Street analysts, not the companies themselves, can tell you with certainty which force wins out. What we can say is that the historical pattern behind this chart has a track record worth respecting, and this time is different, has been said before every single major correction in market history. Sometimes it turns out to be true, sometimes it doesn't. If you want me to make other videos breaking down topics like this, please like and subscribe. Thanks for watching.